Hey everyone, welcome back to Corporate. You can find a LinkedIn hint at why you might want to check your Bain Capital investments before they bang you. In this video, we're diving into Bain Capital investments before they bang you. In this video, we're diving into Bain Capital Private Credit's latest update. And trust me, there are a few numbers here that paint a very interesting picture of their current performance and future plans you'll want to see. Before we get into the nitty-gritty, if you like getting these kinds of clear-cut, no-nonsense breakdowns of financial reports, make sure you're subscribed. And hey, we've got a fantastic community discussing these filings over on our Discord, which you can find linked in the description below. Alright, let's get straight into it. This is a Form 8K filing, which is basically an announcement of important events that shareholders should know about. Bain Capital Private Credit is giving us an update on their distributions and their net asset value, or NI, for their Class I common shares. The date here is July 18, 2025, which is the earliest event reported. So we're looking at pretty current information. Now, Bain Capital Private Credit is the player here. They're a big name in alternative investing, focusing on providing loans and capital to businesses. Think of them as a giant lender fit the typical mold for big banks. They're incorporated in Delaware, which is pretty common for holding companies and investment funds in the US. Their main office is in Boston, Massachusetts. Nothing too surprising there, but it grounds us in where the decisions are being made. One interesting note is that they are checking the box for being an emerging growth company. This means they're relatively new or fit certain size and revenue criteria and can take advantage of some relaxed reporting rules. They've also elected not to use the extended transition period for new accounting standards, which tells us they're aiming to keep their financial reporting up to date with the latest requirements. First up, they're talking about their July 2025 distributions. This is essentially communicating how much money they're paying out to their investors. For the Class I common shares, they've declared a regular distribution. Let's look at the numbers. The gross distribution for Class I shares is $0.875 half share. Now, a key thing to notice here is the shareholder servicing and/or distribution fee. In this case, it's listed as $0. That's right, zero. So the net distribution is the full $0 to $1.875 per share. This is pretty good for investors as it means all of the declared distribution is going directly into their pockets without any fees eating into it at this stage. These distributions are set to be paid out around August 29, 2025 for shareholders who are on record as of July 31, 2025. So if you're an investor, mark your calendars. The money will either come to you as cash or be reinvested to buy more shares in the fund, depending on your preference. Now, let's move over to their net asset value, or NAV. This tells us the market value of all the assets minus liabilities. As of June 30, 2025, the NAV per share for Class I shares was $25.83. This number is super important because it's a key indicator of the underlying value of your investment in the fund. More broadly, as of that same date, the fund's total NAV was $644,644.05 to significant chunk of assets. Their entire investment portfolio was valued at $1,018,158,805 a lot of investments they're managing, and the amount of debt they owe is $592 in Winnian dollars. Now let's put that debt into perspective. Their debt to equity ratio is about 0.92 times. This basically means for every dollar of equity they have about 92 cents of debt supporting it. It's not alarmingly high, but it's definitely a notable amount of leverage. They also break down their net debt to equity ratio, which is debt minus their readily available cash. That comes in a bit lower at about 0.82 times. This suggests they have a reasonable cushion of cash to handle their immediate obligations relative to their debt. Let's look at how their money is actually invested. As of June 30, 2025, their $1,185 $1 million portfolio was spread across 136 different companies. That's 36 companies, which suggests a fairly diversified approach, reducing risk concentrated in just a few businesses. And these companies are in 26 different industries. A wide spread like this is good because if one industry takes a hit, the impact on the overall fund is likely to be much smaller. Breaking down the types of investments, a massive 92% is in first lien senior secured debt. This is the safest kind of debt lending. It means if a company struggles, Bain Capital Private Credit gets paid back first, and they have collateral backing their loans. This is a very conservative and low risk allocation for a debt fund. The rest is a small slice of subordinated debt, preferred equity, common equity, and then some in an investment vehicle. The heavy weighting in senior secured debt signals a strategy focused on capital preservation and predictable income rather than high risk, high reward plays. Another critical piece of information is that 93% of their debt investments are floating rate. This means the interest payments they receive and thus the income they generate will go up or down based on market interest rates. In a rising interest rate environment like we've seen, this is a big advantage as it means higher income for the fund. They are actively raising money with a goal to raise as much as $2 in shares. As of the July 1, 2025 subscription date, they had sold a good chunk of this. They've issued 25,608,169 Class I shares, and the total money they brought in for these shares is $651.6 million. They've raised about $651.6 million towards $6 million towards their $2 billion goal. This means they still have a substantial amount to raise, likely continuing to offer shares monthly. As they mention, it shows they're actively attracting new capital. Now, looking at these results more broadly, Bain Capital Private Credit appears to be operating a very stable and relatively low-risk strategy. The massive allocation to senior secured debt and the high percentage of floating rate investments suggests they are prioritizing safety and trying to benefit from current interest rate trends. The fact that they're paying out gross distributions without taking fees is a positive for their current shareholders, showing that the underlying investments are performing well enough to cover costs and then some. However, a few things are worth noting. While diversified across 136 companies, the debt to equity ratio of 0.92 is on the higher side for a conservative strategy, though the net debt figure is a bit more reassuring. They still have a significant amount to raise in their current offering, which will be a key focus for them. Managing that influx of capital effectively into their strategy of secured lending will be crucial. In terms of risks and opportunities, the floating rate nature of their portfolio is a clear opportunity in a rising rate environment, potentially boosting their returns. The main risk would be a significant economic downturn that leads to widespread defaults, but their focus on secured debt offers a buffer. The challenge will be deploying the continued capital raises into new loans that meet their strict underwriting criteria. Overall, Bain Capital Private Credit seems like a well-managed fund focused on generating steady returns with a strong emphasis on capital preservation. The key takeaway is their conservative approach to lending, which, while potentially limiting explosive growth, offers a good degree of stability, especially in the current economic climate. Alright, that's our breakdown of Bain Capital Private Credit's latest filing. What's your take on these numbers and what they signal for the company's future? Do you think their conservative lending strategy is the right move? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out and lets YouTube know to show these videos to more people. And of course, subscribe for more deep dives into the world of finance. Don't forget to check out the Discord community linked in the description for even more insights. Thanks for watching, and we'll see you in the next Decode.